Hello everyone, welcome to this yet another edition of Market Review. Today I have with me Raghunath and in OPSTRA with Definedge Securities we have options of commodities also and as well as the intraday charts for the individual commodities like crude, oil, gold, silver, everything. And over the years we have seen that options are quite liquid in crude oil as well as in natural gas, not so liquid in gold, but crude oil and natural gas have good amount of liquidity and consistent liquidity in options. So today Raghunath will be explaining to us one strategy which he has used this month, almost since 15 days, and the logic behind that strategy and what is the trade and how it progressed. So welcome Raghunath, and you can explain the strategy now.
Thank you, AP. So here the trade that I took was in crude oil. And the logic is very simple. If you look at this candlestick chart, so the trade I took was around 15 or 14 February, and before that, the crude oil was the price was resisting at 6,700 level, and then it was finding support, quite a bit of support at 6,000 levels.
Yeah, you can see almost three times 6,700.
Three times it touched, and at the 6,000 level also it touched three times. So the hypothesis was that if it is going to again come up, that first I'll short 6,700 call and then see how it progresses, and if it works in favor of me after shorting the 6,700 call, then I will short the 6,000 put, where at the level at which it was finding support again and again.
So basically, you started with a naked call short and then converted it to a strangle.
Yes. So the advantage of doing this strangle at two different time points, okay, is that you can make a strangle with a much wider payoff.
Wider payoff and a range also can be.
Range, yeah. So your break evens will be much farther away. So I'm going to show you like where I took the trade for the call option as well as put option. So in the case of call option, when after it went to 6,700, and the next day I took it's on 14th of February, I shorted a 6,700 call. Okay, and fortunately after that the crude oil went down by up to 6,100 or so. So when it went to 6,000,
so this is a daily chart, right?
Yeah, this is the daily chart. So when it went to 6,100, then I shorted 6,000 put option.
So because that time you had the cushion from the 6,700
Yes,
call.
yes. So I had the profit from 6,700 short call, and when it went down, then I shorted the 6,000 put option. So these are the two prices.
Only thing is compared to equity markets. Options in equity. The options for shorting. The margin required for shorting commodities options is a bit more, right?
Yes. So for a crude oil option, the margin can be anywhere between 2 to 2.5 lakhs.
For one lot.
For one lot.
Okay.
So you have to bear that in mind, that the margin requirements are very
so you
high.
will at least double the capital to make sure
yes,
for it.
Yes. So that's one important. For example, in this case, the combined margin requirement for this triangle is 4.4 lakhs.
Okay.
Okay. So as I said, so I got two different option prices when I shorted 6,700 call, which was around 230 rupees. And for short 6,000 put option, I got 150 rupees. Okay. So the idea behind is that you can use charts and levels and use that knowledge to do the option strategies.
So it need not be a strategy where you enter both at the same time.
Yes.
It can be a segregated,
Separate as well.
Separate trades. Yeah.
So it need not be a pure option strategy,
Yeah.
but using chart knowledge and then use that to enter the option strategy. Now the advantage here is that because I entered them at two different times when the price was very favorable to me.
So you got a total of almost 380.
Yes, 380. So around 38,000 of
So
maximum possible.
effectively, what it means is only if crude goes below 5,700 on the lower side and above 7,000 on the high side, only then this
Then
strategy might come into loss.
yes, come into loss. So you have like your almost.
In fact, it is here the payoff
Yeah, you can see
5,600 and
break-evens,
7,000. Yeah.
yeah. So you have almost 1,500 points of range
Yeah.
for break-evens. So that's the advantage of doing it this strategy in a staggered manner instead of doing in one go.
In fact, I have also observed one thing. I don't know what you have seen, but when a new expiry starts in MCX, or rather crude oil, of course, there are several different dates for different expiries,
Yes.
especially for crude oil. What I've observed is for the first 10 days or so, options are very expensive for
Yes.
crude. And that time, it might not pay to go into a naked call or naked put long.
Okay.
That
Yes.
doesn't pay much. So, in fact, I have seen for the first 10 days, like we have shown, strangle works, even a straddle works.
Yes.
So that is the better way to approach crude options. First 10 days, concentrate on shorting straddles or strangles or maybe a spread,
Yeah.
and not to look at naked longs. That is
Yes.
what I've seen.
Yes. I mean, there are many other possibilities. This is just one of
Yeah.
the strategy using options. And and also one point I want to mention here is that now in OPSTRA on the securities version, you can plot these payoff charts, which may not be available elsewhere.
Yeah.
So that's one advantage of doing here the payoff charts for crude oil. So you also have the knowledge of break evens, and if you need to make any adjustments,
Right.
so that will be much easier when you have that visual of payoff chart.
Yeah, that will definitely help. Another way of looking at it is, which of course is what he doesn't use, but I use quite regularly. So in fact, this is the chart which I tweeted last night. This is the same strangle, which is plotted on a 1%. Why 1%? Because the 0.5% has lots of columns, so 0.5 can be changed to 1% when there are many columns on the chart. So this is the same triangle, 6,700 call and 6,000 put. And you can see how beautiful it is drifting down continuously over the last 10 days or so. And right now it is near 117 and it is still going down. In fact, just today it has given another double bottom sell. And now the stop loss, if one wants to follow it, will be just above this L2, which is quite favorable. Looking at the entry he got, of course, he got a staggered entry, that's why the total was 380. Even as per the chart, the entry could have been here, which is near 300, 310. So this was a way of looking at the same trade on the straddle chart. What he did was looked at the same trade first, looking at the chart of crude oil, then took the call short, then took the put short. So there are different ways of looking at it and executing it.
Yeah. So as they say, you can skin in n number of ways.
Yeah, and finally, all roads lead to Rome.
Yeah. I mean, we are targeting a good profit in
Yeah, that is
the
exactly the
strategy.
So
that
maybe
is our
who knows, if crude oil expires between 6,000 to 6,700 over
Yeah.
the next 10 days, this will go to zero.
Yeah, this will go to zero, and you will be able to capture all the profit in this case.
So the point of this video was first of all how to approach different ways of looking at the market, especially commodities market. That is number one. Number two is like I said, over the first week or 10 days, don't look for long options because if there is not a big large trend in the underlying, in this case crude oil, that will not pay. So it's better to stick to spreads or maybe strangle or straddle. In fact, I have in the past tweeted straddles for crude oil. That also gives a good profit over the something like 5-6 days, and that also tells what is the range within which the commodity will be range bound. So unless that straddle chart breaks out, there is no point in going directional. So better to stay non-directional. Maybe in the last 1 week or so, it might happen. So that we have to wait and see. But as of now, right now it is trapped in that range of 700 points.
Yeah, and also recently, what happened, because of the war in Ukraine and Russia, there was huge volatility in crude oil.
Yes.
So it went up to 10,000 and came back to 6,000. So because of that huge volatility, the premiums are very high.
Even now the premiums are
Even now premiums are very high. So that's why I was able to short these options at very high premiums. So you will find good premiums in the case of crude oil options compared to stock options or
Yes.
index options, if you relatively, if you compare them, you'll find good premiums in the case of crude options.
In fact, same is the case with natural gas also. In
Yes.
fact, it is more volatile than crude
Yes,
oil.
it's even more volatile. So you will find very good premiums because of these commodity markets by nature are very volatile.
In
So-
fact, there is a joke. One of my friends who trades natural gas regularly, he said, "I have heard Bank Nifty is very volatile."
Yeah.
So another friend said, "If you are used to trading natural gas, Bank Nifty is nothing in front of it."
Yes. Because commodity markets are like that.
Yeah, and again, it depends on international news,
Yes.
evening session, and there are other things which are involved, unlike Bank Nifty.
Yeah.
So we hope you like this video, and this was just an insight into how to look at options in commodities, especially crude. And do subscribe to our channel, like it, and share it. Thank you.
Thank you.